My name is Michael Guyad, publisher of the Lead Lag Report. Is our special guest, Professor Danny Blanchflower. I'm just going to go with Professor, if that works for you
Yeah,
when I
cool.
address it. So, Professor, first time you and I are talking, first time you're doing space, as I understand it. For those
Sure.
who are not familiar with who you are and your field of study, explain to the audience your background a bit.
Well, I'm a labor economist, and I've spent my life trying to understand wages, unemployment, and well-being, and trying to compare countries. And so lots of the work I did initially were really about wages and unemployment. And in 2006, I was asked by Gordon Brown, who subsequently became Prime Minister, to join the Bank of England's Monetary Policy Committee. So I was there from 2006 to 2009. And by the middle of 2006, 2007, it was clear to me that a giant financial crisis was coming. And from October 2007 through around September 2008, I essentially dissented at essentially every meeting that I thought a great crash was coming. And then in subsequent years, I've worked a lot on macro policy, and the most recent stuff I've been working on are actually about could you forecast turning points, and could you think about where we are now and what's the prospects of the US and other countries being in recession. And my data basically predicts that the US is headed to recession in the next year.
There's a lot of different directions we can take this. I've been saying to people more recently that it would not surprise me if we're in a recession now. And I only say that because if you're a cynic, you'd argue that inflation is much higher than reported CPI numbers. And if that's the case, then probably from a real GDP growth perspective, you may already be negative, right, in terms of where we are now.
Well, I mean, the answer is actually that people think inflation's actually much higher, but the truth is, in all probability, it's a lot lower. I mean, the Boskin Commission actually looked at exactly that question and concluded that the actual numbers were probably too high. I mean, the reality is that obviously inflation hurts, but so does the alternative. And all the evidence we have is that the alternatives are much worse. So the research that I've done, just to put people in people's minds, what effect does a 1 percentage point rise in inflation, say from 4 to 5, have on well-being compared to a 1 percentage point rise in unemployment? And the answer is unemployment is 5 times worse. So the question is, what is the solution worse than the problem? And I was just teaching my class of students right now. And the answer is, if you look back at inflation, inflation goes up and it comes down really fast because people can substitute away from it. Obviously, policy impacts. Unemployment does not. And the evidence, it seems to me, is that especially if you look at measures that predict inflation, predict turning points, so the fear of unemployment series in Europe, and that's horribly increased. Looks like Europe's headed to recession. The ECB is not going to raise rates. And if you look at the consumer confidence data in the US, it forecasts 6 of the last 6 recessions, and it's now it's in recession territory already. And it predicts a rise of a couple of percentage points in unemployment by February 2023. Now, maybe that's wrong, but that's the best indicator we have. And so, it's all very well to say inflation is a big issue, but it goes away. People can substitute away from it. And I think the expectation is that this is transitory. So it would be a mistake, in my view, for the Fed to be tightening. And we're not going to see, and in the UK, similarly, MPC seems to have made an error in tightening. So I don't really hold the view that the markets have. And remember, the markets completely had it wrong in August 2008.
Yeah, I will add that I've been making this point that the biggest thing that would help the Fed break inflation is at least some kind of a deceleration or maybe some kind of turnaround in housing prices, right? And with this mortgage rate shock that's happened, you're already starting to see the leading indicators like lumber, for example, breaking down, right? On
Exactly.
that structural drop.
The answer, you're right, in the sense is that the Fed doesn't have to tighten if the markets think the tightening is coming. Effectively, they've done the tightening. But I think the answer is that, consumer confidence is a really big deal, and if you look at that really is collapsed. It's collapsed more than it. So if you look back at 2007 and you look at it predicted what was coming at the end of 2007. If you look at the conference board data for the 8 biggest states and look at it in May 2007, It very much predicts what comes in December. Well, the falls that we've seen in 2021 and 22 are even bigger. Now, you might say it's different, but if consumer confidence is falling, that's going to impact output. It's going to impact sales. Firms are going to slow because consumer spending is going to slow. So why would the Fed be raising rates when recession is already in train?
Yeah, I mean, I guess the counter would be that they would rather try to break inflation quicker than let it perhaps become a self-fulfilling cycle. Now that's debatable, right? It may already be in that sort of a phase.
Well, I mean, I just was literally showing exactly the graph to that. If you look back, you have data. If you just go to the BLS, the Bureau of Labor Statistics website, you can see inflation, monthly inflation back to 1913. And there is no examples actually at all in those 100 years times 12 months. There's no examples where a high inflation actually remains embedded. What it does is it goes up, hits a spike, and it comes down even faster than it went up. So there aren't really any histories of that. And if you go really from 1990, I mean, I was actually thinking there's nobody who's basically alive as an adult who's observed inflation in the United States of over 20. Nobody's ever seen that. And in fact, most people alive, the problem has been inflation has been too low rather than too high. They've had more episodes of deflation. And what goes up rapidly comes down, unlike unemployment, which goes up and doesn't rapidly come down, especially for the most vulnerable. So who are we trying to tighten the economy for? Maybe for people who've got bets on what's going to happen to interest rates, but that's not what the real economy is about. The
Right.
scale of the shock has been so huge, and the tightening and the relative tightening of fiscal policy has been so huge that's meant that interest rates have had to remain at zero, and in many instances, actually below zero across other central banks. So it really is a strange argument to say that when it's not appropriate, you should raise rates so that you can cut them later. Why would you possibly do that? The reason that you wouldn't do this is the scale of the shock and the uncertainty that we're faced by is so great that you really just look back at the errors that the European Central Bank made twice, the Swedish Central Bank made. So the only major error, and the Fed between 2015 and 18, all were errors. And the answer is we have no clue what's coming in terms of Omicron. We've no clue what the impact of the war is. The only thing that it looks like is all the risks are to the downside. And the consequence of high inflation is worse than every other of the alternatives. So it seems to me that sitting, waiting, watching the data is the right thing to do. But and anybody who says things like the Fed is going to raise rates, whatever number, at best is they're simply picking numbers out of a hat, or else they're just making it up. And they have no clue because they have no idea what the data is. We have no past history of this. So my view is that as a person who voted on interest rate 36 times, we don't know. And this is not the time to do anything foolish. And tightening and doing further rate rises as the data starts to weaken would be a fundamental error.
It also seems strange to me, right? Because the Fed arguably with raising rates, you can argue impacts demand pull inflation, but not necessarily cost push, right? And
Correct.
it's right. So
Correct.
and so all this is really not going to help that much. And
Correct.
if housing is breaking down, that's going to be a
Yeah,
disinflationary force from a demand pull perspective.
correct. Well, I mean, so think of the logic. Why are we seeing this? Why are we seeing all this stuff going on in the labor market and so on? What we saw was a giant pandemic with a lockdown, and that impacted the ability to get stuff from around the world. We had a big increase in the demand for timber. Prices of timber rose, but we basically import lots of that timber, but we couldn't. We had a supply chain sets of problems. So how is the Fed raising rates, dealing with this issue of supply chain issues? But the other thing is that the assumption in the data is that we get monthly impacts of data, and we drop a month and we gain a month, and the expectation is unless we see another supply side shock coming, then substitutions of things eventually will result in the inflation being transitory. So unless we're going to see another supply side shock, then there's no reason to believe that inflation is anything other than going to fall, as it done in every occasion in the past. By default, with 100 years of data, we know that inflation is transitory, and by default, the people who say that it isn't are the ones who have to explain to us why this time is different, and there's no evidence that to actually say that. As you rightly say, this is a supply side problem, not a demand side problem.
Okay, I want to go back to some of the research that you've done in the past. You mentioned the term well-being.
Yeah.
I'm curious how you define well-being.
Well, actually, we've spent a huge amount of time trying to understand this. So there's various ways of doing it. We essentially you can ask people simple things about how happy they are and how contented they are, but those things all turn out to be incredibly correlated with all sorts of other things, like what do you think about the economy? What do you think about employment? What do you think is going to happen to unemployment? What do you think is going to happen to your job? All of that stuff turns out to be crucial, and it turns out that you can actually validate this against all kinds of things. So the first thing we have in the United States is Deaton and Case have documented a rise in deaths of despair. Well, those deaths of despair are actually from people whose well-being is very poor. They're in despair. That's a really big one. Another example is that we can show that well-being is validated against all kinds of stuff. So, well, people who are happy smile more. But here's a really big one. If you take surveys, and people have just done this recently, if you look at people at the age of 65 and you ask how happy they are on whatever measure you like, what their well-being is, that predicts really well how long they're going to live. It's a great predictor of their longevity. So the answer is that you might think that economics, I mean, as a policymaker, I always took the view that, what all these things like GDP and unemployment and inflation, all of that were simply intermediate things. Why do we care about them? Because we care about people's well-being, their standard of living, and so on. So ultimately, what we're talking about is the well-being of people and countries. And it turns out this is a hugely important area. And I like the idea that, in fact, instead of sort of saying, oh, inflation, how important is inflation or unemployment, you actually go and measure it, which is what I did. I did it in a paper for the Boston Fed and showed that, basically, I just don't think people have really thought through, and you said it quite well, but people have not thought through, okay, you're going to raise rates to lower inflation. Well, what are the consequences of doing that? And the reason central banks and central bankers like me were reticent to do it is that all the alternatives were worse.
So it sounds to me like you would agree, and correct if I'm wrong, that the terminal rate of interest rates, it's in sort of a secular decline no matter what, right? I mean, it's, in other words, you can never really raise rates any sustainable high level because debt is so high, and you do that now the interest expense is basically your tax base.
Yeah, I mean, and a good example is the UK, obviously, where I know a great deal about, having been on the Bank of England's Monetary Policy Committee. Well, what you saw today was, well, essentially now taxes in the UK economy are higher than they've been in the last 40 years. The national insurance went up today by 1.25 percentage points. And fuel bills, energy bills, went up by 50% in the last week, and they're about to go up by 40% again in September. And the MPC raised rates 3 times. Well, guess what? The UK is headed for a recession, basically driven by the stuff that we've talked about, but also overly tight fiscal policy. Very, very likely the UK is going to go into recession, and the moves by the MPC, in my judgment, were absolutely asinine, and they're going to have to reverse them very quickly, because the highest tax rate in 40 years at a time where 1 in 13 people in the UK already has COVID today. So I just think this is all very well, but this is not dealing with the world of uncertainty that we're in, the world of a COVID shock, supply side shock. We've been hit by a war, and people want us to go back to where we were in 1999. Well, that's just cloud cuckoo land. I call most of what's gone on, I believe, to be guessonomics. I'm a data guy. Look at the data, see what precedent there is in the data, and then work from there. And likelihood is the Fed is going to have to be impacted by what it does, by how the data looks. What if next month the inflation rate drops by 0.8? Does that mean the Fed's going to carry on doing what it said, and the next month it drops by 0.7? So all these people who say they're going to raise rates 5 times. Okay, I'm back. Sorry, I don't know why I keep losing you.
No worries. Okay, I was saying something real quick, but the idea of defining happiness to me is kind of a strange concept, purely because happiness, I think, is probably more relative than not. Right. So I use the example of if you hit some kind of zenith, some kind of go ahead.
Yeah, absolutely. So the evidence is, so think of the telling evidence in the United States is that happiness levels have actually declined as GDP and incomes have risen. So it's certainly true that people compare themselves to others, and relative things absolutely matter. But if you think in economics, that's not a simple thing that we do. We teach, 5 is preferred to 4 and 4 is preferred to 3, but relative things may well matter. So yes, certainly we've seen that. One of the important areas of work that people do is, well, who do you compare yourself to, right? So when you're 20, you probably compare yourself. Well, when you're 15, you compare yourself to the person down the street. So these comparators are really interesting. Relative things absolutely matter. And so, purchasing of a BMW perhaps doesn't make you as happy as you'd think if the next door neighbor buys one as well. So there's lots of that work that people do. I take your point. But I mean, in a sense, they've lost power now. I mean, I remember in 2008, by the fall of 2008, it was clear that interest rates, to deal with the scale of the shock in any of the models we have, interest rates had to go to about -4. Now, clearly, they couldn't do that. Well, we didn't even realize how negative they could go. So you ended up going to quantitative easing. Okay. But the issue you're asking is, down the road, you'd like to be in the position where you can cut rates by 500 basis points when a shock comes along. I agree with that. But that's not a reason to make a mistake now to cause a recession. So you raise rates now, you cause a recession, you have to cut them again, caused by your increase in rates. This says more about fiscal policy and it says more about austerity than it does about the central bank. But what happened was that fiscal authorities tightened fiscal policy and then said to the central banks, off you go. And basically, we're sat at the zero lower bound and lower. And the Fed's going to raise rates, right, as the ECB is going to cut them or not raise them. So we're in a global world here. And if you're the ECB, you say, go ahead, the Fed, raise rates. That'd be great. You go do it. Look what it'll do to our exchange rate. That'd be a great thing to do. But if that's a great thing to do, it's really probably not a great thing to do. So the problem is, it's not everything's so American centric. But why would you? It's like saying, would you like, here's 3 choices. You'd like, I'll punch you in the face really hard, I'll punch you in the face kind of gently, or I won't punch you in the face. Which would you like? And you should always choose, I'm not going to punch you in the face. That's why I think what you said is incorrect.
I want to go to the name of the space for a second, Professor, because it relates to your book. Where have all the good jobs gone? This is something you often hear in sort of the popular narrative. I don't know if too many people really understand what that actually means definitionally. What is a good job? So lay out the thesis behind your book and sort of how you think about job market. Yep.
Yeah, I mean, there's a great. I actually started out years ago trying to think about what full employment was. Coming from the UK, people don't know this, but Beveridge was asked by Churchill to go off and think about what full employment would look like after the war. So that's a position where essentially full employment is where job offers are coming in and people can kind of choose the job they want and be on their labor supply curves. So what do I mean by that? I mean that if you're unemployed and you'd like a job, you can get a job. But also, big phenomena in this world here is if you have a job with too few hours, you can get a job with more hours. If you've got a job with too many hours, you can get one with fewer hours, and security would be there. And so that's the sort of thing that I have in my head. But the book actually starts out with a quote which I really quite like, which is, it's a quote from Gallup. And if you go to Gallup's website, what they actually say is, they actually say, we've been in business since 1935. What the whole world wants is a good job. And I like their definition, page 1 of my book. And they say, a good job is one working 30 or more hours a week for an employer that provides a regular paycheck. That'll do. 30 more hours a week with a regular paycheck. And so I think, and the answer is that those kinds of job offers would come in when you were at full employment. And anybody who thinks that we're at full employment today or have been anywhere near full employment in the last decade doesn't understand the labor market. We've seen huge amounts of underemployment. The phenomenon over the last decade has been, why has wage growth been so low? And the mistake people made is to have looked at the unemployment rate, which is no longer a decent indicator of what's happening.
So continue on that point there. So good job, 30 hours, regular paycheck, and people don't quite understand why wages have not gone up.
Yeah, and I think I have an answer, which is that actually the big phenomenon in the United States is why was wage growth for the period since 2008 weak? Well, so what happens is the wage didn't mean revert, so it's a non-mean reverting variable, and everybody out there seems to want to use the unemployment rate to explain which mean reverted to explain a variable that didn't. So what you want is variables that are not mean reverting. Well, underemployment is a good example. So you say, oh, we're at full employment. If we're at full employment, how come there are all these people out there who'd like more hours? Because if we were at full employment, then they would be able to move back to their labour supply curves and find jobs with more hours, and they can't. So underemployment is the thing now that keeps wages down. There's lots of labour market slack in the economy. So then you go back to the question we asked before: shouldn't the Fed raise rates? Well, why would the Fed want to raise rates when the labour market has got huge amounts of slack in it and is enjoying some degree of improvement, but still real wages are still real wage growth is still negative. I just think this is a complete misunderstanding of how the economy, the situation the economy is in, and what's basically happening is that all this tightening and talk of tightening is basically tanking the economy, which is headed to recession. And all the comments people make about how many Fed rate rises there will be are completely wrong. The only issue is how many cuts they're going to have to make.
I'm curious your thoughts on unions, Professor, because
Right.
there's an argument out there that you'd have wages on a real basis rise if you had more bargaining power
Right.
by workers.
Right. So obviously the question is that at full employment, worker bargaining power is higher, right? And so you'd start to see things happening. I mean, in the UK, I'm noticing that actually for the first time, strikes start to pick up. But the one thing that you've observed is a decline around the world in unionization rates. And what the phenomenon I've just talked about underemployment is actually a phenomenon in non-union labor markets. Because I mean, essentially unions control everything. They control hours of work and who leaves and retirement and all sorts of things. But some of the story that we've observed is that the world's become more global. Unions have struggled to survive. The stronger ones are the ones that are left. We actually did see in the last couple of years some improvement in unionization rates around the world, perhaps as some groups of workers felt more powerful. But in some sense, the rising globalization is actually explains the inability of unions to raise the price, because if you raise the price, then employers say, "Ha, why should I work here? I can move my production to Spain or wherever." So unions are a big part of this story, and they've been in decline all around the world. The question now going forward is, will that change? And obviously, the vote at Amazon in New York this week is an intriguing one. But the absence of unions is what's led to underemployment, because, as I say, unions fix hours, and usually union workers have more hours because they like the hours are fixed, and then they get overtime. And they keep out other groups. So unions have changed the world here, and they've impacted inequality too. The fact their absence has meant inequality has risen. So there's a lot of research on that.
Is it a bigger factor than technology when it comes to replacing jobs and keeping wages
Well,
lower? I'm curious sort of the
Well, no,
interaction
it's
there.
a really good point. Let me just focus in a sense on the books. Let me focus a little bit on the second part. So the book talks about good jobs, and obviously a story is about technology. And I always remember learning. I was doing A levels in England when I was 17, and I learned about the Luddites. And the Luddites, were machine breakers because they thought machines would take away jobs. The first thing I would say to people is that if you look around you, I mean, what we're doing here is a function of technology. So technology in many instances has actually created lots of jobs. Look at the Apple Store and so on, Tesla. But the question, in a sense, we have to ask ourselves is, the only reason that you would have technology impacting jobs is that it's about prices. So if you lowered the relative price of work, that changes the capital labor substitution. So a macro policy that encourages employment and gives employers subsidies for hiring people, there's nothing wrong with that. But that capital labor market substitution might solve the problem of capital being substituted for labor. Maybe the right thing to do is to say, we'll give employers a bigger subsidy to hire people. and that might actually raise the country's well-being, because one thing we really know is that unemployment makes people unhappy. Being out of the labor force makes them unhappy. Being underemployed makes them happy. Having a good job makes them happy. So that might be a really good goal in itself, because I don't care about the well-being of a machine, right? It's there to help us do stuff. Absolutely. So let me take the second one. It's actually very interesting you say the thing about the rise of big firms. May I encourage people to go and read? It's the latest edition, just out this week, by the latest Nobel Prize winner, David Card, who actually wrote the column exactly about what you've just said. And he talks about what's called monopsony power. And I think it's called Who Sets Your Wage? And the answer, certainly, he talks about the fact, so he won the Nobel Prize just a little bit ago. And the evidence certainly is that the firms have greater amounts of bargaining power. Go back to your earlier point about as well, the other question. So I agree with that. I think that's an important thing. And as I say, Carl's just written about that and thinks it's an important issue. In terms of workers' rights, I think there are two things. The first one is the rise of globalization, right? And the removal of protection and barriers to trade and so on. And I think that's a big part of it. And obviously, as I said a minute ago, the ability of firms to move has meant that workers' bargaining power has been somewhat limited. But if you go back to the early work on unions by Richard Freeman and James Medoff and others, the talk is that unions in principle could actually be very positive. They could be positive for productivity. They could emphasize what they call voice aspects of work and do all kinds of things, provide insurance policy and provide health insurance and so on. But they chose not to do that. And so if you think there's a market for unions, that's pushed unions down around the world. Disproportionately
I
are
think
is in the public sector.
Yeah, no, I think we lost you for a second there, but it's fine. Yeah, no, I think that makes sense.
I mean, go back to. I mean, I don't know about the union structure, but I mean, think about where unions exist. Unions disproportionately exist where the firm has monopoly power, right? And so both unions and firms would like monopoly power to rise, and the union can bargain rent when the firms have got monopoly power. As perfect competition comes, the role of a union declines.
Right. Makes
So
a lot of sense.
so that's why in the public sector you might think of so think about. I mean, I've done a lot of work on setting wages of public sector workers. Think of teachers, police. Um, they have strong bargaining power, and their ability, for example, to go on strike and send the kids home is a big deal.
In terms of more recent research that you've done, Professor, I saw something about happiness by gender and other things, just kind of on the periphery. I'm just curious, what are some of the things that you've been focusing on?
Here's something that's we're doing. Yeah. So one of the questions is, who's been impacted the most by the shock, and it certainly appears that women have been impacted by it. And so what we see is a lot of evidence now on all kinds of data that on all sorts of measures of well-being that women are less happy than men. But we've been actually trying to do some stuff related to what you've talked about. Can we validate these? Do they have some real value? And so we've actually been looking at pulse rates. And then perhaps people will be surprised to hear that pulse rates seem like a very good measure of well-being. And in fact, golfers these days, like Rory McIlroy and others, have been wearing monitors to show their pulse rate. So here's something: your pulse rate is impacted by your age, your income, your location, your gender, your race, all sorts of, and whether you're unemployed or not. So there's all kinds of stuff about, we can track people's pulse rates and show that this may well be a variable that we care about, and we know that pulse rates are predictive of things. High pulse rates predict stuff. So I think a lot of the things that we're talking about is well-being related to these kinds of things. But let's just go back a second. A major problem in the United States has been deaths of despair. 100,000 people a year are dying from opiate poisoning, people dying from suicide, and so on. And these are major problems. So these are major issues, and you would certainly relate back to my book, which is that we, both Deaton and Case and myself, think that a great deal of this relates to people's failure in the labor market. So you say you're at full employment, but how come all these people are basically unable to find work that their parents or their grandparents had? They can't find jobs with decent wages, and they are dying from deaths of despair. But we're ignoring that, and we say everything's fine, the labor market's great, it's time to raise rates. Well, what about these left behinds? And the left behinds around the world, as I say, are dying. They voted for, they may well vote for Le Pen in France. They voted for Brexit in Britain. They voted for Trump in the United States. These are issues about people being left behind in the labor market, and so we care about their well-being. I'll give you a statistic, which is that if you take prime age, less educated folks in the United States, and you ask them, over the last 30 days, how many of those 30 days were bad mental health days? 1 in 7 say every day. Every day of my life is a bad mental health day. So these are important things for us to understand, that this stuff we've talked about here, the Fed saying we can raise rates, but what about all the people that you've left behind who are not able to get work? Work seems to be crucial. Causing a recession always makes things worse. The times get to be the best times turn out to help. So think of who gets impacted the most. So the most marginal workers, let's say it's young black men in the inner city. Turns out in bad times they're the ones who are impacted the most and the worst. But in good times, those are the ones who benefit the most. So the argument is to help them by having a recession makes no sense. I never bought the argument that we should actually create a giant recession to kill off zombie companies. The problem is that we kill off all the non-zombie companies as well. So that doesn't really make much sense. The other thing about bad work is that bad work is a function of lack of demand for people. It's a function of not being anywhere close to the labor market. So I explain to my students, think of the job pyramid. When times are good, so imagine there's a pyramid and the president's at the top and you enter it at some point along the ladder. Well, times are good, then people who are just high school graduates get to rise up the job pyramid. And when times are bad, they get to enter lower. But the problem is that when times are bad, they enter lower, and there's evidence that they never catch up. So here we are in a position where we're talking about tightening, where there's huge amounts of slack in the labor market, and by raising rates, that will just make things worse. The tighter the labor market, the greater the demand for work, the less likely there are to be crap jobs. In the UK, there are a thing called 0 hours contracts. Well, 0 hours contracts disappear when the demand for labor rises. As you move towards the full employment, workers' wages start to rise. So then you're in a position. I remember Paul Krugman talking about this. If you focus on wages, the worrying thing is the time suddenly when workers start to do better, you then start to raise rates. Just understand that for production and non-supervisory workers, the real wage today remains below what it was in 1974. So the argument that we pay people less, we give them more unemployment, we make life tougher for them, and that will make them work, doesn't make any sense. There's no evidence in the data to sustain that. People like jobs, they like better jobs than worse jobs. And insecurity in work is a really big, major negative to their well-being, and an inability to get a pension and healthcare and so on lowers their well-being, raises the prospect of poor mental health, and raises the prospect of them taking drugs and committing suicide. So I couldn't really disagree more.
How does all that jive with the labor force participation rate, right? Because that's always been
Yep.
sort of an interesting dynamic with unemployment. You've had a large number of people that are not supposedly working. I don't know how they're spending.
Well, we don't know what they're doing, right?
Right.
Well, yeah. So let's go to the labor force participation rate. So the first thing is that the labor force participation rate is much lower in the United States and has declined much more in the United States than any other country. And you've said it correctly. We don't exactly know why. So people say things to me like, "Oh, it's because of aging, and it's because of technology, and it's because of the availability of benefits." And I say, hogwash, that's completely not true. And the reason it's not true is that so go to Canada. Canada hasn't had this declining labor force participation rate. It has the same aging, it has the same technology, and it has more generous benefits. So I think your point is well taken, the one you just said, which we don't actually know. We don't exactly know what they're doing, but let's just understand this. if the labor market was to tighten and the labor market was to move to full employment and the wage under offer was to rise, those people would come out of the labor force and join the labor force. So employment would rise, the employment population rate would rise, and the labor force participation rate would rise. And so it is a very major puzzle why it is in the United States that the labor force participation rate is so low. But it has nothing to do with the things that mostly people talk about, because every other country had it, so it can't be that. So I think the answer is that then we've condemned these people to, what are they doing? This is lost output for the economy. It seems a major issue, and I think of these people frequently as the left behind, and we need to do something about it. But to actually say we write them off because we look at the unemployment rate, we say it's low, but those people are neither in the numerator or the denominator of the unemployment rate.
Yeah, no, that does make sense. It's interesting. Anecdotally, there's been stories, or I guess some evidence that suddenly there's a lot more truckers on the road,
Right.
and that there's this concern around people actually transporting goods now is no longer as big of a concern. And it's curious as to what caused that. Why is there suddenly a surge of people now getting back into
Well,
work?
it's quite. I mean, the book talks a lot about this. So I talk a bit about. I think there's a section on plumbers and truckers in the book. So the issue, in a sense, is about prices, right? So the first problem was that the pandemic generated people weren't driving around and so on. But ultimately, the question is, what kind of a job is being a trucker? So you get in your truck and off you go. What's the relative price of being a trucker compared, let's say, to driving a delivery van, an Amazon Prime delivery truck around your town? And the answer was the relative price of working for Amazon was actually more attractive than driving a big truck. So the issue is, well, it's a simple issue. I'm an economist. So why is there a shortage of truckers? Because you didn't pay them enough. Duh. So what's very hard about that? The jobs become less attractive. If you want to get more truckers, then you pay them more. And what we're starting to see is that that's what's actually happened. So people are then attracted to go from, being a delivery driver in the local area. So that's been true around the world, but in general, prices move to clear markets. So I think it's a simple answer: you just pay them more. I mean, I talk in the book about a disagreement that I had with someone, a journalist in the Wall Street Journal, who kept talking about a shortage of plumbers, and I said, well, the question is what's happened to the price, and if the price hasn't moved, then there's no shortage. If there was a shortage, the market would respond, and that's what's happened.
So there's this old, I forget the which economist originally said this, but the argument that wages are downward sticky, right? So you can't really lower wages once they've been increased. Do you think there's a risk that as these wages have increased, as people are getting paid more, that it actually could make unemployment on the next downturn even larger
Well,
because you can't adjust the wages, right? And they're at a higher starting point.
the evidence is clear that we have adjusted wages. Actually, we started to adjust wages by making insecure contracts, giving people fewer hours than they would like. I'm a professor. I'm an endowed professor with tenure. But the universities, what have they done? They've got around that by hiring lots of people, grad students and short-term contract people and so on. So what they've done is they've changed the mix of those kinds of people, but they've also reduced them. I mean, they've reduced the numbers of people. Think of, there used to be a union worker, and when times come along, you can't fire the union workers. Well, there's fewer unions. But as I say, I think that we will see about when the shock comes along. But when you tighten an economy thinking you're at full employment and you're not, then what you've done is you're going to create the Great Recession yourself right now. And that's what's happening. And that's what's happened several times. Misunderstand the nature of the labor market and worry that wages are about to rise. So then you tighten, and that's what's happened. So I just think the conversation today ought to be, so all the conversation about the Fed is wrong. The inflation rate's nothing to do with too much demand. It's to do with supply shocks. And all the talk of raising rates will just generate recession. And that will be much worse.
All right, maybe I'll take this in a slightly different direction. So, um, how do you see skill adoption going forward in the sense that, in this kind of battle between technology and humans,
Yeah.
right? Technology we know is exponential, right? And humans are much more linear, right? In the way they learn things. And people can't keep up with how fast technology and algorithms are
Mhm.
replacing, more and more complex different things. So, how do you think about sort of the longer term interplay of technology and
Yeah.
job growth?
Well, I mean, I think if you think back to my story about the left behinds are the ones who've actually got inadequate skills, right? So what's happened is you haven't got any skills. We can actually use a production in China or Vietnam to produce this stuff cheaper than you have. The issue in many senses is that the gainers, you and me, who gain by cheaper priced goods out of Walmart, didn't compensate the losers enough, and then they become discontented. But related back to my point about the relative price of labor, well, what we're going to need to do is we're going to need to have much more skilled labor. And what it turns out is countries like Germany and Austria and so on around the world are much better at actually doing the sort of training that you need. So there are apprenticeships throughout Germany and other countries in Europe, not just in metal bashing, but in service sector and so on. So what we need to do is, I mean, that's exactly a good point. We're going to need skilled people. We need to subsidize work. We need to encourage the skill acquisition. And in some sense, the winners can compensate the losers because it's cheaper than just letting them lose, as we've observed. So I think a huge momentum to help skill up the population is a really good one. And that helps firms because it's going to lower the relative price of labor and encourage them to hire people rather than machines. And I don't think that if you believe in markets, there's anything wrong with that. So I think you're absolutely right. We need to develop apprenticeship programs. Particularly, we're going to look at things like community colleges and so on, where think of the skills that we want to see. Think of a plumber. Think of a carpenter. Think of any number of these people. I mean, my dishwasher gets repaired, and the guy comes along. He's a computer guy. He says, I don't get wet. I don't do wet stuff. Someone else does that. I just come and look at your board and I sort your board out. Well, presumably this guy's not making $25,000 a year. So these kinds of jobs are good jobs. And I think we encourage them and fund skilled training. And I think the United States has been really bad at that. And we have a whole class of people who've been left behind because of their lack of skill and their lack of ability to adapt to things. And I think that's a really big deal and a huge. I mean, an example is just this idea where you say, okay, we're going to insulate 3 million houses. Well, we'll take lots of these people and we'll educate them and train them so that they can go out and insulate houses. It has a benefit that it reduces energy consumption, but it actually gets them trained and gets them doing worthwhile things when they're going to get paid a wage that's a decent wage. So that's not hard to think about. I'm a labor economist. That's what we should try and do, is improve the workings of the labor market. So which way around is it? So if we go to employment rates, if you take the employment rate, and that's from the household survey. Remember the coverage of the household survey. It includes marginal workers, right? It includes the self-employed, includes private workers in private homes. Yeah, I mean, but the thing in a way is that when you go to the household survey, the employment to population rate. So you can calculate employment, you can calculate the population, which you can't in the establishment things. I mean, so that's a percentage point below where it was. There's all these issues about in April 2020, the official unemployment rate was 14.7, but they collected the data wrong and it was really 19.7, and they've never adjusted to it. So I'm happy to perhaps maybe write to me and I'll think about it, because I'd have to sit and look at the data. I probably have an explanation. But the collection of data and around the world, so in the UK, they've announced they're going to recalibrate and redo how they count things, and so I think there's an issue. But I'm not sure that if you think that the establishment survey has re-established. Well, why don't you write to me, Blanchflower@dartmouth.edu, and let me have a look at it, and I can probably answer it. Well, you're quite right. I mean, I think that the gap between urban and rural areas is a really big deal. I have a little bit of it about it in the book. But if you just to give an example, so an example is um, life expectancy in urban against rural areas. An example is, supposing you're injured in a car accident, what's the probability that you'll survive? And the answer is much greater in an urban area than a rural area, because of a number of things. Because in rural areas, people don't use seatbelts, they speed more. But actually, it turns out the probability of them getting to a top grade hospital is slim. If you arrive alive at a hospital within an hour, the probability of you surviving is high. So rural areas, the gap there is the first one. And let me just go to another one. The reality in the United States, I bet people don't know this statistic. If I was to say to you, what proportion of people over time do you think, what has happened to mobility over time? Do you think it's risen over the last 50 years or declined? And the answer is, over the last 50 years, mobility has declined by 50%. So people in rural areas where, if the issue you say is there's issues there and there's problems about getting access to healthcare and getting to a hospital and so on, the reality is that people don't move out of these rural areas. They don't roll out of these areas in Appalachia. This relates to our zero in the participation rate. We have been very bad at discouraging people from moving. So I think that's part of it. I suspect people will be surprised. That's in the census data. So if I say to you, did you move within your county? Did you move between counties in your state or between states? In the last 50 years, that's halved, and all of those measures. And so there is an issue in rural areas, and we need to encourage people to move.
Yeah, I thought that's what COVID did, but I guess only somewhat.
Yeah. Well, obviously in COVID, what's happened in rural areas, the COVID rates, death rates and so on have been especially high in those rural areas because of access to, to a hospital and to healthcare things and so on, and to vaccinations. So there has certainly been a growing urban-rural divide. I agree with you, and I think that's particularly, and it's particularly true in my stuff about deaths of despair and so on. Those rates are much higher in those rural areas. And life expectancy is different, and there is certainly a divide, and there's a divide in many senses, a political divide, because those rural areas are disproportionately Republican, and the city areas are disproportionately Democrat, and that's where our national divide is.
Yeah, I think that's going to be a conversation for another space. So everybody that's been here for the hour, really do appreciate everybody joining. I think this was a very thoughtful conversation. Please make sure you follow Professor Blanchflower here on Twitter, and obviously check out his research. And everybody, again, I try to do these spaces, conversations daily. I'll have another guest tomorrow. Enjoy the rest of your day, and thank you, Professor, for joining. I really do appreciate it.
Thank you, and sorry I kept losing it, but it wasn't me. I didn't do anything.
All good. Thank you, everybody. Thank you, Professor. Thank you, everybody.